Welcome to The Explainer. Today, we are going to break down ARKO Corp's really interesting second quarter earnings. You had a report that looked kind of weird on the surface, but sent the stock flying. So let's get into what actually happened.
And let's start with the only number that really matters right at the top. The stock popped a massive 13.5% right after the company dropped its results. I mean, that is a huge move, and it definitely caught a lot of people off guard.
And that's because, well, here's the puzzle. ARKO actually missed its revenue numbers. Usually, that's a one-way ticket down for a stock. So the big question is, what on earth did the market see that the top-line numbers weren't showing?
To really get why the reaction was so bullish, we have to peel back the layers here. You gotta look past the headlines and dig into what's really a story of two completely different metrics.
This quarter's story is, for sure, a tale of two metrics. You've got top-line sales fighting against bottom-line profit. And, well, investors, they definitely picked a side. Okay, so this table pretty much explains everything you need to know. On the one hand, yeah, revenue missed what analysts were expecting by about 2 to 3%. But, and this is a huge but, look at that bottom line. Their official profit, GAAP earnings per share, absolutely crushed estimates by 33%. And at the same time, their merchandise margins actually got better, which means they're making more pure profit on the stuff they sell.
So here's the key takeaway. Investors just completely looked past the revenue miss. They didn't see it as a sign of weakness. No, they saw it as a calculated side effect of a much bigger and, frankly, much smarter strategic plan.
So what is this grand strategy? It's a full-on transformation plan, and it's built on a pretty simple idea. Go after high-quality profit instead of just chasing empty sales numbers. And the whole thing really boils down to one key concept. And that key concept is a single word: dealerization. So what in the world is that? Simply put, ARKO is selling some of its company-run stores to independent owners. Now yeah, that makes their own retail revenue number go down, but they're replacing it with something so much better: stable, high-margin income from things like fuel contracts and rent. They're basically turning themselves into a landlord and a wholesaler, not just a retailer.
And you know what? The playbook is absolutely working. They converted another 70 stores just this quarter, bringing the total up to 282. The math here is really simple. Management thinks this is going to add over $20 million in operating income every year, plus another $10 million in cost savings. It's a direct trade. They're swapping low-quality revenue for high-quality profit. And this whole thing isn't just about selling off stores. For the locations they decided to keep, the CEO, Ari Kutzler, made a point to talk about all the money they're investing in new store formats and loyalty programs. And the early results are looking good. They're seeing stronger sales in the stuff that really makes money, like food and coffee, so they're making their core assets even more valuable. So all this success with their strategy gave management the confidence to put out a really stable outlook for the future, which, believe me, is exactly what Wall Street wanted to hear. They backed up that confidence by keeping their full-year guidance in place. And for the next quarter, they put out a forecast that basically screamed more of the same. Their great Q2 performance of almost $77 million sits right in the sweet spot of their new Q3 guidance. That tells investors that this new, higher level of profitability is probably here to stay.
You tie all that together, and you get a market sentiment that turned, let's call it, cautiously bullish. Investors saw the growing margins, and the steady guidance has proved that dealerization isn't just some fancy corporate buzzword. It's a real, credible plan to build a much more profitable company.
So that brings us to our favorite part, the next call. What's our take on ARKO from here on out? Here's our analysis and what we think is a pretty plausible trade idea based on everything we just saw.
So our rating is outperform. It's pretty clear the market is rewarding ARKO for a really smart and disciplined transformation. This isn't just about cutting a few costs here and there. No, this is about shifting to a fundamentally better business model that generates higher quality earnings. And in our view, a story like that deserves a higher price tag.
This leads us to a plausible trade idea, a pair trade. The concept is simple. You go long ARKO stock, you buy it, while at the same time you short a basket of its competitors. The whole thinking behind this is that ARKO has this really powerful, unique story that's all about self-improvement. It kind of insulates them from the broader economic woes that might hit their rivals. While everyone else is fighting macro headwinds, ARKO's busy re-engineering its own success, and that could let it totally outperform the rest of the sector.
The big question now, of course, is just how much more value can this whole dealerization strategy unlock? That's what we'll be watching for next quarter. And as always, just a reminder, this analysis is for informational purposes. It is not financial advice.